Okay, welcome back to the 2009 cash and production budgeting question. And we were just on the part C, preparing a cash budget, and we had a certain amount of entries prepared already. We're about to move on to the fixed overheads here. So, fixed overheads, it says, including depreciation, were 29,000 per month payable as incurred. But since depreciation is a non-cash expense, it can't be included in a cash budget. So we need to figure out how much the depreciation is, subtract it from the 29,000, and the remainder will go in as the fixed overheads amount per month. So, to find the depreciation, equipment will be purchased costing 30,000, which will have a useful life of 5 years. Now, it doesn't mention that, but we assume that this means that it will have no residual value after 5 years. So if we take the 30,000 divided by 5, it will be going down in value by 6,000 each year, each of those 5 years. But since this is a monthly budget we're doing, we want to know how much it's going to go down in value per month. So we're going to further divide it by 12. So that gives us 500 per month. So the depreciation on that equipment will be 500 per month. If our overheads are 29,000 per month, including depreciation, if we subtract 500 from this, we get 28,500, and that's how much we put in here as our fixed overheads amount. 28,500, 28,500, 500. Next item, I suppose, as we go down along here, wages done, variable overheads, fixed overheads done, equipment will be purchased costing 30,000. Well, that goes straight in. It's purchased in January, so into January's column here, we just put down equipment, 30,000, one entry. We're not going to be purchasing equipment every month, so that's it. The last one then is to finance this purchase, a loan of 24,000 will be secured at 10% per annum. Interest to be paid monthly, but capital loan repayments will not commence until July. So since our budget only goes as far as April, we don't have to worry about those repayments because they don't start until July. They won't go into our cash budget here. The interest, however, will need to be paid monthly immediately from when the loan happens. Now, if the loan is for this equipment which is purchased in January, then we assume that the loan is also in January. So the loan was 24,000. It said in the question that it's 10% per annum. So if I get 10% of that by multiplying by 0.1, gives me 2,400. And that's 2,400 per year per annum. So that's the annual interest, but we want to know again the monthly interest. So if we divide by 12, that gives me 200 euros per month. So up here again, and we enter 200 euros in the January, February, March, and April columns. Now, that's it for the payments. Now we need to tot up these columns here. And I'm just going to pause for a second to add them up. Okay, so these are the totals. This is the total of this, plus this, plus this, plus this, plus this. And this is the total of everything here also, etc. So the next thing we need to do is we've got our total money coming in, receipts, our total money going out. So what we do is we subtract our money going out from our money coming in. So in this case, this will be subtracted from that. It's going to give us a minus figure, obviously, because there was more going out than was coming in. So we'll show minus figures by using brackets. Subtract this from that, it's going to give us another minus figure. We'll put in brackets. This from that, it's going to be a positive. This from that, and it's going to be a positive. So I'm going to pause again while I subtract each of the total payments from the total receipts. Okay, so those are the net cash figures. It means you will be, at the end of January, this business will be minus 72,200 euros in money. However, during January, we know from the question that it said, excuse me, that they were going to get a loan of 24,000 to help to purchase that equipment. So we put the loan down in here to offset the amount of money that we're going to be down. So that's a plus 24,000 because we're getting money in from that loan. Also, you may see in other questions, occasionally people like to put the loan figure up with the receipts with the money coming in, which isn't wrong, it's fine, but more traditionally we put it down here. Okay, so the next thing then is the opening balance. So the opening balance is the amount of cash they had at the start of the month, but since again this was a new business, there was no opening balance. So then to work out our closing cash or our closing balance, how much money we'll have at the end of the month, we take our net cash and we add on this loan. So when I add this minus figure and this plus figure together, I get a minus 48,200. So that's how much money you won't have basically at the end of the month. You'll have minus 48,000 euros at the end of the month. So this closing balance then, the money you have at the end of the month, will be your opening balance for the following month, because whatever you have at the end of January is what you have at the start of February. So we bring this up here, minus 48,200. Then we add it to this other minus we have up here to give us our closing balance at the end of February, and if we add the two of them together, it gives us a total of minus 67,640. And again, our closing balance for February becomes our opening balance for March, because whatever you have at the very end of February is the same thing you have at the very start of March. So it's a minus 67,640. And again, if we add that to whatever we had our net cash at the end of March, then this time this is a plus 104 and a minus 67, so we're finally in positive territory. That will give me a plus 36,790. And again, that closing balance will become the opening balance for the following month, 36,790. And things are looking much healthier then at the end of April, because when we add this to 124,000, we get a plus 160,820. And that's it.